John Bogle, born on May 8, 1929, in the United States, was a visionary investor and the founder of Vanguard Group. He played a significant role in shaping the modern landscape of investing and finance. Bogle's pioneering ideas and relentless pursuit of investor-friendly practices revolutionized the industry. One of Bogle's most notable achievements was the introduction of index funds. In 1976, he launched the first index investment trust, the first-ever index mutual fund available to individual investors. This innovative approach aimed to provide investors with a low-cost, diversified investment option that closely tracked a specific market index, such as the S&P 500. Bogle's index fund concept challenged the prevailing belief in active fund management and opened doors to a new era of passive investing. Bogle's philosophy centered around the idea that investment success should not be predicated on speculation or market timing but rather on long-term discipline and adherence to fundamental investment principles. He advocated for low-cost investing, believing that excessive fees eroded investors' returns over time. Bogle relentlessly pushed for transparency and fairness in the financial industry, advocating for the rights and interests of individual investors. Through his writings and speeches, Bogle became a prominent voice in championing the importance of long-term investing, diversification, and staying the course during market volatility. His book Common Sense on Mutual Funds provided invaluable guidance to investors, emphasizing the need for a prudent and patient approach to wealth accumulation. Bogle's contributions to the field of finance extended beyond his innovations in index fund investing. He actively campaigned for corporate governance reform and greater accountability in the mutual fund industry. His efforts led to increased awareness and scrutiny of excessive fees and conflicts of interest, ultimately benefiting individual investors. Overall, John C. Bogle's enduring legacy lies in his relentless pursuit of providing ordinary investors with access to low-cost, long-term investment strategies. His vision and achievements continue to shape the investment landscape, empowering individuals to make informed financial decisions and work towards their long-term financial goals. 1. The stock market is filled with individuals who know the price of everything, but the value of nothing. Bogle's quote challenges the prevalent focus on short-term price movements and speculative trading strategies. It emphasizes the need for investors to dig deeper and assess the underlying value of a company or asset. While market prices can fluctuate based on various factors such as market sentiment or short-term trends, the true value of an investment lies in its underlying fundamentals. Understanding the value of an investment involves analyzing factors such as the company's financial health, competitive advantage, growth prospects, and management quality. By focusing on these fundamental aspects, investors can make informed decisions that align with their long-term goals and minimize the impact of market volatility. Bogle's quote also serves as a reminder to avoid herd mentality and the temptation to chase short-term gains. It encourages investors to take a more disciplined and patient approach, looking beyond the immediate price fluctuations and considering the long-term potential of an investment. By recognizing the distinction between price and value, investors can adopt a more rational and informed perspective. They can seek opportunities where the market price may deviate from the intrinsic value, presenting potential opportunities for long-term investors. Bogle's quote underscores the importance of a comprehensive analysis and a focus on long-term value creation rather than short-term price movements. In summary, Bogle's quote urges investors to look beyond the surface-level price information and delve into the underlying value of investments. By embracing a long-term perspective and conducting thorough research, investors can make more informed decisions that align with their financial goals and withstand the test of time. 2. Time is your friend, impulse is your enemy. Bogle's quote serves as a reminder of the importance of time and patience in the world of investing. It highlights the idea that successful investing is a marathon rather than a sprint. By adopting a long-term perspective and avoiding impulsive decisions, investors can navigate the ups and downs of the market more effectively. The quote suggests that time can be a friend to investors. It implies that the longer you hold onto your investments, the greater the potential for compounding returns. Time allows investments to weather short-term market volatility and benefit from the overall growth of the economy and companies over the long run. Patient investors who stay committed to their investment strategies and resist the urge to make hasty decisions based on short-term market movements often see better results in the end. On the other hand, the quote identifies impulse as an enemy to successful investing. Impulsive decisions driven by fear, greed, or the desire to time the market can lead to suboptimal outcomes. Trying to predict short-term market fluctuations or chasing after hot investment trends often leads to buying at inflated prices or selling during market downturns, potentially resulting in poor investment performance. By emphasizing the importance of discipline, Bogle encourages investors to focus on their long-term goals and stick to their investment plans. This means avoiding knee-jerk reactions to market volatility and staying committed to a well-thought-out investment strategy. It also means resisting the temptation to make frequent changes to one's portfolio based on short-term market movements. In summary, Bogle's quote underscores the value of time and patience in investing. By recognizing time as a friend and impulse as an enemy, investors can make more rational decisions, stay committed to their long-term goals, and avoid the pitfalls of emotional investing. Taking a disciplined approach and embracing a long-term perspective can contribute to more successful investment outcomes. 3. In the fund business, you get what you don't pay for. Bogle's quote draws attention to the significant role of fees and expenses in the investment fund industry. It highlights the idea that investors often receive lower net returns due to the fees they pay for actively managed funds, which strive to outperform the market. The quote suggests that investors should be mindful of the costs associated with their investment choices. While some actively managed funds may boast of superior performance, the fees charged by these funds can eat into the overall returns. Over time, these expenses can have a substantial impact on the growth of an investment portfolio. Bogle advocates for a more cost-effective approach to investing, specifically through low-cost index funds. These funds aim to replicate the performance of a market index, such as the S&P 500, rather than trying to outperform it. By avoiding the high expenses associated with active management, index funds generally offer lower fees, allowing investors to retain a larger portion of their investment returns. The quote serves as a reminder that investment costs matter and that minimizing fees can be a crucial factor in achieving long-term investment success. It encourages investors to consider the impact of expenses on their overall portfolio performance and to seek out low-cost investment options that align with their investment objectives. Furthermore, Bogle's quote underscores the concept of getting what you don't pay for. By selecting low-cost index funds, investors benefit from broad market exposure and diversification while keeping expenses in check. These funds can provide a cost-effective way to participate in the overall growth of the market, allowing investors to capture a significant portion of market returns over time. In summary, Bogle's quote emphasizes the importance of cost management in investment funds. It encourages investors to be mindful of fees and expenses and to consider the long-term impact of costs on their investment returns. By opting for low-cost index funds, investors can reduce expenses and improve their chances of achieving better net returns over the course of their investment journey. 4. The stock market is a giant distraction from the business of investing. Bogle's quote shines a light on the misconception that the stock market itself is the primary focus of investing. He suggests that too much attention and energy are often directed towards market fluctuations and short-term trading activities, which can distract investors from the core principles of successful investing. By referring to the stock market as a giant distraction, Bogle underscores the importance of shifting one's perspective from short-term market movements to the fundamental aspects of investing. Instead of getting caught up in the daily ups and downs of stock prices, he encourages investors to focus on the underlying businesses and their long-term prospects. The quote emphasizes that successful investing is not about trying to time the market or chasing short-term gains. It reminds investors that the essence of investing lies in understanding the businesses behind the stocks and making informed decisions based on their long-term potential. Bogle's philosophy aligns with the principles of value investing, which emphasizes the analysis of company fundamentals, long-term growth prospects, and the purchase of stocks at attractive prices. By focusing on the underlying business performance, investors can develop a more sustainable and disciplined approach to investing. The quote serves as a reminder that the stock market is merely a platform where stocks are bought and sold, and it should not overshadow the core principles of investing. It encourages investors to prioritize factors such as diversification, asset allocation, and a long-term perspective. In essence, Bogle's quote urges investors to avoid getting caught up in the noise and short-term fluctuations of the stock market. Instead, they should stay focused on the fundamental aspects of investing, including the analysis of businesses, prudent portfolio construction, and a long-term mindset. By doing so, investors can position themselves for more meaningful and sustainable wealth creation over time. 5. The courage to press on regardless of whether we face calm seas or rough seas, and especially when the market storms howl around us, is the quintessential attribute of the successful investor. Bogle's quote emphasizes the essential quality of perseverance and emotional resilience in the world of investing. He highlights that successful investors possess the courage to press on regardless of the prevailing market conditions, whether they be calm seas or rough seas. The quote acknowledges that investing is not always smooth sailing. Market storms, characterized by volatility and uncertainty, are bound to occur. However, Bogle emphasizes that it is during these challenging times that the true mettle of successful investors is tested. By using the term quintessential attribute, Bogle suggests that the ability to persevere and maintain a steadfast approach in the face of market storms is a defining characteristic of successful investors. It is this unwavering commitment to their investment strategies that sets them apart. The quote also highlights the importance of emotional resilience. Successful investors do not let market fluctuations or external pressures dictate their actions. Instead, They maintain discipline and focus on their long-term investment objectives. Bogle's message resonates with the concept of staying the course and not succumbing to short-term market noise. It underscores the significance of having a well-defined investment plan and sticking to it, regardless of the market's ups and downs. Moreover, the quote emphasizes the importance of maintaining a long-term perspective. Successful investors understand that market volatility is a natural part of the investment journey and that short-term fluctuations should not distract them from their long-term goals. They recognize that enduring market storms can often lead to favorable outcomes over time. Ultimately, Bogle's quote serves as a reminder to investors to cultivate the courage to press on, regardless of market conditions. It encourages them to remain committed to their investment strategies, maintain emotional resilience, and focus on the long-term objectives that they have set for themselves. By embodying these qualities, investors can navigate the ever-changing landscape of the financial markets and increase their chances of achieving long-term financial success. John C. Bogle's book Common Sense on Mutual Funds offers invaluable insights into the world of investing. His quotes serve as guiding principles for navigating the complexities of finance and economics. Join us in future episodes of Financial Perspectives as we explore more influential voices and their contributions to shaping the world of finance.